Hi, I'm Jimmy. In this video, we're going to look at the US economy. We're using different economic indicators to see if we can objectively gauge where the economy stands today. And then we'll try to answer the question, should we invest now or should we wait for the stock market to crash again? Okay, so let's jump right in. So first up, we have consumer confidence. Now, historically, the consumer is one of the biggest drivers in the US economy. And last month, we actually had this as a bearish point, a negative point, because it was drifting lower. But this most recent pop in the number implies that it could be strengthening, or at least potentially strengthening. So if with this in mind, I actually think it makes some sense to shift our negative point into a neutral point. So over on our scorecard, well, now we have a point for the bulls and for the bears. Okay, moving right along. Next up, sticking with the consumer, but now we're going to look at household debt as a percentage of GDP, or gross domestic product. And this economic indicator is exactly what it sounds like. It tracks how much debt like credit card debt, car payments, mortgages, things, personal loans, things along those lines, relative to the size of GDP. Now, this is a quarterly number, and the most recent number came out was for December of 2020. And as we could see, well, this big jump here happened when COVID happened, although recently this number did appear to drop some, so it's not quite as high as it was. Now, I still think that this is a negative sign for the broader economy, especially when we consider that back in the 1990s, look at how low the number was back then. Granted, interest rates were lower back then, so it would make some sense to have more debt now with lower interest rates. But still, even off of very recent time periods, this number, I think, is too high and could end up being a drag on the overall economy. Either way, this is going to be a point for the bears. So over on our scorecard here, well, now we have one neutral point and 1 point for the bears. Now, along these same lines, very similar to household debt to GDP, there's another economic indicator that is put out by Equifax. They're a credit bureau. And basically what they do is they track the number of credit cards. Specifically, this is a percentage of credit cards that are more than 90 days late. So clearly, higher numbers here are a bad thing. And the fact that this is up higher than it was implies that this could be a problem. These are people that are having trouble paying their credit cards. In fact, they haven't paid it in at least 90 days. So this is clearly going to be a drag on the economy. And once again, a point for the bears. So over on our scorecard, we have a few negative points. But now we're going to shift over to the yield curve. And this one is actually a tricky one. And I'm afraid that I've been using it wrong. I've used this for a few months now, and I accidentally did not give the proper picture behind the yield curve. So here's what I mean. The Treasury yield curve shows us what the interest rate is, or the yield for different Treasury bonds. And Treasuries, they have a whole bunch of different types of bonds. Some expire 3 months, 6 months, 2 years, 5 years, 10 years, 30 years. There's a lot of bonds out there. But this is exactly the way it's supposed to look. If you invest for just 3 months, you would receive one interest rate. If you invest for 30 years, you'd receive a very different interest rate. And it's supposed to move higher just like this. That's supposed to be the shape of the yield curve. So they call this a normal yield curve. But what if we were to switch back to February of 2020? Well, here we can see that short-term interest rates were higher than some longer-term interest rates, which by definition is an inverted yield curve. Now, when the yield curve inverts, this is supposed to be a predictor of an economic recession to come. And as we know, well, this happened in February of 2020. Shortly after that, the economy really turned lower thanks to the coronavirus. That is exactly why this inverted like this. And this brings us to the mistake that I made with the yield curve. So what I've done is I've looked at the yield curve and said, hey, look, here's the present day one. I look at this and say, hey, look, it's a normal shaped yield curve. This is a good thing. This is not inverted. It is properly shaped. Therefore, it's a point for the bulls. But the reason that was a mistake is that the predictive power of, sure, with the coronavirus, going back to the February chart, it happened very fast. But that's fairly unusual. Usually it can happen with some time, as far as, let's say, a year ahead of time, sometimes even longer, but a year now should be enough of an example. So I think it's unfair to look at 1 month and say, hey, this is a normal yield curve, everything's great. Since it's possible that we have a normal yield curve today, but if last month the yield curve was not normal, well, that could mean that the economy could be in trouble down the road. So with that being said, I think it makes sense to start from March of 2020 That was after the last inversion of the yield curve, also when the economy really turned bad, and scroll through each of the months. Now we can see that clearly this is going to be a point for the bulls. I had it as a point for the bulls last month, and it's still a point for the bulls this month, because as we go through these months, we can see that the yield curve has stayed consistently positive and consistently properly shaped. So over on our scorecard here, well, this is going to be the first point for the bulls. Okay, now we're shifting over to the job situation. First, we have jobless claims. And clearly, this is a bad sign. The current level, although it's not getting worse, is clearly not getting any better. So I think it still makes sense to give this point to the bears at this point. And then when we look at unemployment, this is the unemployment rate, well, we can see that it also makes sense to give this one a neutral point. That's what we gave it last month. Now, the reason I went neutral and not negative on this is that the short-term trend appears to be heading in the right direction. But the overall level is still well too high compared to where it could be, or at least where it was before COVID. So I think over back here on our scorecard, I think it makes sense to give this one a neutral point and a negative point for the jobless claims. Okay, now we're shifting over to housing. So our first economic indicator for housing is it's put out by the National Association of Realtors, where they track the average price of housing of existing home sales, not new homes, existing homes. And we can see that the average price is in fact drifting higher. And historically speaking, increasing housing prices at a reasonable rate have historically been a good sign for the broader economy. And then when we shift over to new houses being built, well, new houses being built are also drifting higher. So I do think it makes sense to give this a bullish point on top of existing home sale prices, because now we have the prices going up and new houses being built, which should be two positive signs for the broader economy. Now, we should point out that the most recent number is in fact a dip lower, but we're really a month or two away from seeing if this is if it truly breaks lower from the shorter term trend. So for now, I think that it makes sense to give both of these points to the bulls. So over on our scorecard here, now we got 2 points for the bulls, and we're starting to even this whole thing out a bit. Okay, now we're on to manufacturing. So this economic indicator, this is the ISM manufacturing indicator, and this is put out by the Institute of Supply Management. That's what ISM stands for. And basically, the higher the number that this is, the stronger manufacturing is growing. So the key level here is 50. Anything below 50 is negative growth. Anything above 50 is positive growth. And we can see that the number has recently ramped up quite nicely. So this implies that the manufacturing sector is getting stronger. And obviously, this is a brighter point for the broader economy. If manufacturing does well, that should help the overall economy. So easy point for the bulls here. Okay, now this brings us to the question, does it make sense to invest now or wait for the stock market to crash? And the first exception to even asking this question, I talk about it every month, but I really think we should point out that if we're talking about dollar cost averaging or investing out of our paycheck into 401k or 403b or some retirement account, that is really an exception to this question. We should continue to do that no matter what. So we shouldn't try to time our retirement investments, just keep consistently doing it. But here's the real problem that I'm personally finding with investing right now, outside of course, consistent investments, retirements, dollar cost averaging, things like that. Keep doing that. But beyond that, my problem is that I haven't been able to find many undervalued stocks. I'm having trouble finding fairly valued stocks, never mind undervalued stocks. So while I'm not afraid of this economic situation, if we look at this scorecard, this seems fairly neutral. And this is okay, usually not going to get things to tilt in one direction or the other by an extreme amount. I'm just worried about where to find the value right now. And I'm not willing to just sit back and start broadly buying, stocks or ETFs for the entire market, because I do think that stocks at this point look to be overvalued. Now, I'll do a video in the not too distant future looking at the current valuation of the stock market relative to its own history. But for now, as we're looking, I have no trouble with the economics of this. I think it makes sense to invest, but where do we invest? That's the trouble that I'm having right now. So if we can identify companies that have reasonable growth prospects, but are not way overpriced, or even not, hopefully they're undervalued, if we can identify those companies, well, then I would be more than happy to jump right in and invest in those immediately. And if you know any companies like that, please let us all know in the comments below. And beyond that, I actually did a video just recently where I talk about 7 of the most popular dividend stocks right now. And I'm a big fan of dividend stocks. So if you like dividend stocks, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.